When an executive buys stock, investors get excited. When an executive sells, they panic. And when a famous fund shows up in a 13F filing, people rush to copy the trade. The problem is that ownership filings are easy to misread. In this video, I'll show you what insider trading and 13F filings can tell you, what they cannot tell you, and how to use them without overreacting. Start with insider filings. These generally include Forms 3, 4, and 5. But for most investors, Form 4 is the one that matters most because it shows ongoing changes in insider ownership. At a glance, those filings can look simple. Someone bought shares, someone sold shares, and the market is left to interpret the meaning. But insider activity only becomes useful when you understand the difference between the transaction and the context around it. That distinction matters because insider buying and insider selling do not carry the same signal. When insiders buy shares with their own money, that can be meaningful. It may suggest confidence, especially if multiple executives or directors are buying around the same time or after a large decline. Even then, it is still just one piece of evidence, not a conclusion. Insider selling is more complicated. Executives sell shares for many reasons: taxes, diversification, estate planning, liquidity needs, or prearranged trading plans. That is why a single sale by itself usually tells you very little. The more useful question is whether there is a pattern. Are multiple insiders selling? Are the sales large relative to their holdings? Is the timing unusual? And is the selling happening while the business itself is getting weaker? Tesla is a good example of why this matters. Investors often pay close attention to insider transactions at Tesla because the company is high profile, widely followed, and highly volatile. But one well-publicized insider sale does not automatically mean something is wrong. The better question is whether there is a broader pattern and whether that pattern lines up with what the company's fundamentals are showing. It is also important to understand the role of Rule 10.5-1 trading plans. Many insider sales happen under these prearranged plans, which allow insiders to buy or sell shares according to a schedule set in advance. That does not make the transactions meaningless, but it does mean you should be cautious about treating every sale as a fresh judgment about the stock. Now, shift to institutional ownership, especially the 13F. Large investment managers file 13Fs to report many of their US listed equity holdings at the end of each quarter. These filings can be useful because they help you see ownership trends, portfolio concentration, and changes over time. But again, the usefulness depends on how you read them. A 13F is delayed. It does not show a live portfolio. It also does not reveal the full strategy. In many cases, it excludes short positions, certain derivatives, and the reasoning behind the trade itself. So while it can show what a manager reported holding at quarter end, it cannot tell you exactly what that manager is doing now. Berkshire Hathaway is one of the most closely watched 13F filers for that reason. Investors study Berkshire's reported holdings carefully, and those filings can be informative. But even in Berkshire's case, the 13F is best used as context. It can show where reported positions changed, but it cannot tell you the full thesis, the exact timing of every trade, or whether the position has already changed since the filing date. That is why copying 13F filings without context is a mistake. A better use is to treat them as supporting evidence. If you already understand the business, 13Fs can help you see whether institutional ownership is growing, shrinking, or becoming more concentrated in a way that matters. But they are not a shortcut around actual research. The same principle applies across all ownership data. These filings are most useful when they are interpreted alongside the company's underlying fundamentals. If the business is improving and insider buying increases, that may strengthen the case. If the business is weakening and insider selling accelerates, that may deserve attention. But ownership filings rarely tell the full story on their own. So the right mindset is a calm one. Use insider filings to look for patterns, not isolated drama. Use 13Fs to understand ownership trends, not to imitate trades. And always place both in the context of the business underneath them. On secfilingdata.com, you can monitor insider activity and institutional holdings directly from company profile pages, which makes it much easier to follow these changes over time instead of piecing them together manually. If you want a simple takeaway, it is this: insider buying can matter. Insider selling needs interpretation. 13Fs are useful but delayed. And none of these filings should be read without understanding the company itself. If this helped, check the description for links to secfilingdata.com and related filing resources. And if you want more videos on how to use SEC filings intelligently in your research process, subscribe. Smart investors do not just ask what the price is doing. They ask what the business is doing what ownership is doing, and how those two stories fit together.